stocks are down. The FTSE and the Eurofirst down around 1% today. Nothing more than profit taking, is it?
Well, there's a certain element of that, and as you say, if we've seen 12 consecutive months of gains, I think it's only inevitable that we're going to see a little bit of a pullback, especially when you see a 5.5-year high on the FTSE and, of course, on some of the US indices as well. But I think the main thing that is actually dragging the markets down, besides the profit taking, is the fact that although we saw a less turbulent trading session in Japan overnight, we are seeing the futures starting to dive that little bit lower. So I think that is bringing a little bit of caution into the market that probably wouldn't be there otherwise.
As you say, though, we're on for our 12th straight month of gains. That's a record. Pretty impressive.
It's extremely impressive, and when you consider what the FTSE is actually made up of in terms of mainly being weighted towards the mining and the banking sector, it is quite astonishing. We've seen the mining sector, which actually fell down from the beginning of the year as an actual index by over 25%, whereas the banks we've seen gain by about 16 or 17%. So it has been on the lack of decent fundamentals in some respects, and of course we have seen poorer growth numbers coming out from the OECD and the IMF, which has served to drive down base metals, which I think in some respects could weigh on the FTSE later on next month once the markets digest it. But for the time being, it's gold prices that are helping the miners stay on the front foot today and keeping the FTSE from falling too far.
Okay, now the last time, or the last record stretch for the FTSE was 1987 and 1997. Both were 10 consecutive months of gains. 97 held up okay into 98. But we all know what happened in September, October 87. We
did see an extreme crash in 1987. Now, I don't anticipate something of that nature, but I do feel that we're needing to get the fundamentals to stack up to the actual liquidity-infused rally that we've seen over the last 6 or 7 months. And I think that's what's sorely lacking at the moment. You just look to the Eurozone in terms of the unemployment number there today. Again, another record high of 12.2%, and youth unemployment also failing to come back at all, with Spain's unemployment again at a record high of over 56%. So we need to kind of see the fundamentals stack up at the moment. And although I know a lot of the bulls will fall back on the fact that the S&P 500 PE earnings are actually a lot lower than the average over the last 30 years, I do feel that might be a little bit of a misnomer. And I think the last time we saw a 33 PE ratio was around just before the tech boom and the tech bust. So I think we could be looking at a different sort of scenario for now, where the poor data coming out of the US has been the real driver of the markets, mainly because it has been quite addicted to quantitative easing, and I think that has to change.